Consumer credit and debt have been pivotal in shaping American society, influencing everything from individual financial stability to the broader economy. As we delve into the evolution and history of these concepts, it's essential to recognize how they have transformed over the decades. From the early days of bartering and cash transactions to the complex credit systems we navigate today, consumer credit has become a cornerstone of modern life. In this video, we'll explore the significant milestones that have defined consumer credit in America, including the rise of credit cards, the impact of the Great Depression, and the regulatory changes that have shaped lending practices. You'll learn how societal attitudes toward debt have shifted, reflecting broader economic trends and cultural values. By the end of our journey, you'll have a deeper understanding of how consumer credit and debt not only affect individual lives but also drive the economy as a whole. So, whether you're a financial novice or a seasoned expert, there's something here for everyone. Let's dive into the fascinating history of consumer credit and debt in America. The origins of credit in America can be traced back to the early settlers who relied heavily on barter systems and informal lending practices. In the absence of a formal currency, these pioneers exchanged goods and services directly, creating a system where trust and community relationships were paramount. For instance, a farmer might trade a bushel of corn for a carpenter's labor, illustrating how necessity drove these early economic interactions. Community trust plays a crucial role in these informal credit systems. Neighbors often lent to one another based on mutual respect and established relationships, knowing that their reputation was on the line. This reliance on personal connections laid the groundwork for future credit practices, emphasizing the importance of social bonds in financial transactions. Different cultures also contributed to early credit practices. Indigenous tribes often engaged in trade networks that included lending goods with the expectation of future repayment. Similarly, European settlers brought their customs, such as promissory notes, which would later evolve into more formalized credit systems. By understanding these early forms of credit, we can appreciate how they set the stage for the complex financial landscape we navigate today. The late 19th and early 20th centuries marked a significant shift in consumer behavior with the emergence of installment buying. This innovative payment method allowed average consumers to purchase goods by paying in smaller, manageable amounts over time, making previously unattainable items accessible to a broader audience. As a result, more families could afford essential products that improved their quality of life. Key products that popularized installment buying included automobiles and household appliances. The Ford Model T, for example, became a symbol of freedom and mobility, with many buyers opting for installment plans to drive their dream car home. Similarly, appliances like washing machines and refrigerators transformed domestic life, and installment buying made these conveniences attainable for many households. Advertising played a crucial role in shaping consumer behavior during this period. Companies utilized persuasive marketing strategies to highlight the benefits of installment plans, emphasizing affordability and convenience. Advertisements painted a picture of a modern lifestyle, encouraging consumers to embrace new technologies and products. This combination of accessible payment options and compelling advertising not only fueled consumer spending but also laid the groundwork for the credit-driven economy we see today. The Great Depression and credit regulation. The Great Depression had a profound impact on consumer credit, leading to a wave of stricter regulations aimed at protecting both lenders and borrowers. As the economic downturn unfolded, many consumers found themselves unable to meet their financial obligations, resulting in widespread defaults and a loss of trust in credit systems. In response, lawmakers recognized the need for more robust oversight to prevent such crises in the future. The establishment of the Federal Reserve in 1913 became a pivotal moment in credit control. During the Great Depression, the Federal Reserve took on a crucial role in regulating the money supply and stabilizing the banking system. By implementing policies to control interest rates and lending practices, the Federal Reserve aimed to restore confidence in the economy and protect consumers from the fallout of reckless lending. Key legislation emerged during this period to safeguard consumers from predatory lending practices. The Banking Act of 1933, for example, introduced measures to ensure transparency in lending and protect borrowers from unfair terms. These regulations laid the groundwork for a more secure credit environment, ultimately shaping the landscape of consumer finance for generations to come. Post-war consumerism and credit expansion. The post-World War II era marked a significant boom in consumerism and the expansion of consumer credit in America. As soldiers returned home and the economy flourished, disposable income increased, leading to a surge in consumer spending. One of the most transformative developments during this time was the rise of credit cards, which revolutionized how Americans made purchases. With the introduction of the Diners Club card in 1950 and later the Visa and MasterCard systems, consumers enjoyed unprecedented convenience and flexibility in their buying habits. The 1950s and 1960s also witnessed a cultural shift towards consumerism, as advertising and media promoted the idea that happiness and success were tied to material possessions. Families aspired to own the latest appliances, cars, and fashion, fueling a desire for credit that allowed them to acquire these goods immediately rather than saving up. Significant companies emerged during this credit expansion, including American Express and Discover, which capitalized on the growing demand for credit services. This era not only transformed the American economy but also ingrained a consumer-oriented mindset that continues to influence spending habits today. The combination of credit cards and the consumer-driven culture laid the foundation for the modern financial landscape. The evolution of credit cards from the 1970s to the present has transformed the way consumers manage their finances. In the early 1970s, major credit cards like Visa and MasterCard emerged, providing a standardized and widely accepted means of payment. These cards quickly gained popularity, allowing consumers to make purchases without the need for cash or checks, thus revolutionizing the retail landscape. Technological advancements played a crucial role in facilitating credit card use. The introduction of magnetic stripe technology in the late 1970s enabled faster and more secure transactions, while the development of point-of-sale terminals made it easier for merchants to accept credit cards. As technology continued to evolve, features like chip cards and contactless payments further enhanced security and convenience, making credit cards an integral part of everyday life. Alongside these advancements, the importance of credit scores grew significantly in consumer credit decisions. Lenders began to rely on credit scores to assess an individual's creditworthiness, influencing everything from loan approvals to interest rates. This shift emphasized the need for consumers to manage their credit responsibly, as a good credit score became essential for accessing favorable financial products. The credit card revolution has thus reshaped consumer behavior and the financial landscape in profound ways. In the 21st century, consumer debt has reached unprecedented levels, driven by various factors that have reshaped borrowing behavior. One significant contributor is the rising cost of education, leading to substantial student loan debt for millions of graduates. As individuals seek higher education to improve their job prospects, they often find themselves burdened with loans that can take decades to repay. Additionally, the housing market has seen a surge in mortgage debt, as many families strive to achieve homeownership, often stretching their finances to secure a place in an increasingly competitive market. Economic recessions have also influenced consumer borrowing behavior. During downturns, individuals may rely on credit to maintain their standard of living, leading to increased debt levels. The 2008 financial crisis, for example, highlighted the dangers of over-leveraging, prompting many to rethink their borrowing habits. Amidst these challenges, financial literacy has become crucial in managing debt effectively. Understanding how to budget, save, and make informed borrowing decisions can empower consumers to navigate their financial landscape more responsibly. As debt levels continue to rise, enhancing financial literacy remains essential for fostering a healthier relationship with credit and ensuring long-term financial stability. As we analyze current trends in consumer credit, it's clear that technology is playing a transformative role. Fintech innovations, such as mobile payment apps and peer-to-peer lending platforms, are reshaping how consumers access credit. These advancements offer greater convenience and often lower fees, making it easier for individuals to secure loans and manage their finances. Additionally, artificial intelligence is being utilized to assess creditworthiness more accurately, allowing for more personalized lending solutions. Alongside these technological developments, there is a growing awareness of responsible borrowing and financial wellness. Consumers are increasingly prioritizing financial education, seeking to understand the implications of debt and the importance of maintaining a healthy credit score. This shift towards financial literacy is encouraging more individuals to make informed decisions about their borrowing habits. Looking ahead, economic changes are likely to influence consumer credit in significant ways. Factors such as inflation, interest rates, and job market fluctuations will impact borrowing behaviors and credit availability. As the economy evolves, consumers may need to adapt their strategies for managing debt, emphasizing the importance of flexibility and resilience in navigating the future landscape of consumer credit. Overall, the interplay of technology, awareness, and economic conditions will shape the next chapter in consumer credit. In this video, we've explored the fascinating evolution of consumer credit and debt in America, highlighting its significance in shaping both individual lives and the broader economy. From the early barter systems to the rise of installment buying and the credit card revolution, understanding this history is crucial for navigating today's financial landscape. We've also examined the impact of economic changes and technological advancements on consumer borrowing, emphasizing the importance of responsible credit practices. As we wrap up, I encourage you to reflect on your credit habits and consider how financial literacy plays a vital role in managing debt effectively. Being informed about your credit score, borrowing options, and responsible spending can empower you to make better financial decisions. If you found this video insightful, please take a moment to subscribe, like, and share it with others who may benefit from this information. Your support helps us create more content that dives deeper into finance and consumer credit. Thank you for watching, and we look forward to seeing you in our next video.